Good morning, everyone. Today is June, let's see, 17th, Monday, June 17th. So I'm going to record the lecture for chapter 8. So in this chapter, we are learning about how to allocate fixed manufacturing overhead. So there are two possible costing here in this chapter. One is called variable costing. The other one is called absorption costing. So if you take a look at the format for absorption costing, this is to the right side of your screen. You can see this is the format you are really familiar with. So revenue minus cost of goods sold equals gross margin, and then minus operating expenses, that is your operating income. So you should be quite familiar with this format. I believe that you have learned this format from the first financial accounting course, okay? So this is the income statement prepared under absorption costing, okay? And these are used mainly for external users, right? Such as investors. Investors need to make decisions which company to invest. So they would rely on the income statement, the financial statement, right, to make a decision. And then the banker, right? Maybe the company wants to borrow money from banks, right? So the bank loan manager, right? They have to decide whether they want to lend money to the company. So they want to evaluate their company's financial situation based on the financial statement. So when you present this statement for external users, right, the stakeholders outside of your organization, you need to prepare your income statement using absorption costing income statement, okay? However, later on, we're going to learn that sometimes it's more complicated to prepare a statement like this. And for the managers, right, the internal users, right, sometimes they just want to have information that can be generated quickly, right? It doesn't have to be GAAP, right? It doesn't have to be follow the general accepted accounting principle, right? Because it's not for the external users. If they just want to review some information for internal use, right, for the manager themselves, they could have other types of income statement. So in this chapter, we are learning about variable costing, right? If you can prepare your income statement using the variable cost and the variable costing, it's going to look like this, right? This is the contribution income statement format. So you have a revenue, right? And then you have a variable cost, right? This variable cost can include variable production cost, variable operating cost, okay? As long as it's variable. So the difference between these two is called contribution margin, okay? Contribution margin. If you just compare the two formats, right? You can see under absorption costing is called gross margin, and the variable costing is called contribution margin, okay? And then you minus fixed cost, right? Fixed cost. So that's what you get, the operating income, okay? So then you wonder what is the difference between these two formats. The difference relies on the treatment on the fixed manufacturing overhead cost, okay? So under variable costing, it's a fixed cost, right? Fixed manufacturing overhead cost. This is a fixed cost. So it's the expenses, right? So it's like a period cost. So it's treated, if you use the variable costing, the fixed manufacturing overhead cost is a fixed cost. It's treated as a period cost, okay? So that means the cost is recognized on the income statement right away. Under absorption costing, this fixed manufacturing overhead cost is considered to be product cost, right? So in the earlier chapters, we have learned that for product cost, they will not be recognized on the income statement, right? First, immediately, they would first be recognized into the inventory, right? Into the work in process inventory, into the finished goods inventory. So this cost only reach the income statement in the form of cost of goods sold when the products are sold. So that's the difference, right? So basically, for absorption costing, the fixed manufacturing overhead cost will first become part of the inventory, right? And then when these items were sold, then they reach the income statement in the format of cost of goods sold. Okay, so first the inventory and then in cost of goods sold on the income statement. So that's the difference. So obviously the operating income may be different, right? May be different when you use absorption costing versus using variable costing. So in fact that we are able to reconcile between the operating numbers using the amount of fixed product cost capitalized as inventory. So difference between the operating income, okay, figures using the two different costing is actually equal to the amount of fixed product cost capitalized as ending in the ending inventory. This will be more clear once we use one example, right? So when I'm comparing the two costings, so we know that the fixed manufacturing overhead, they will first be part of the inventory as overhead under absorption costing, but they are not product cost and the variable costing. They are fixed cost, period cost. Later on, we're going to introduce the production volume variance, okay? So this is only applicable to absorption costing, not to variable costing, okay? So are classifications between variable and fixed cost routinely made? And the variable costing, the answer is yes, right? Because if you remember the format, right? So you have to classify the cost into either variable cost or fixed cost, right? So that classification has to be routinely made, okay? But under absorption costing, it will be less frequent, right? So I'm going to use one example to illustrate how the operating income may different under different costing, okay? And then how to reconcile the two operating numbers. So suppose this is an operation in the first year, and suppose the revenue is $20 and the $10 is the fixed manufacturing overhead. So this is the first year, okay? So if you use variable costing, this $10 fixed manufacturing overhead cost would be a fixed cost. It will be period cost. So that reached the income statement right away. Okay, so then my revenue is $20 minus my fixed cost $10. So my operating income is $10. Okay. So let's take a look at the absorption, right? Absorption, first, this fixed manufacturing overhead cost will goes to the inventory, right? Goes to the inventory, the overhead, right? So only those costs right, capitalized in those products that are sold, those costs turn into cost of goods sold. So suppose 80% of the production in the first year was sold during the first year. Okay. So the fixed cost of $10, right? 80% of that, that means $8, right? The cost, $8, actually reached income statement in the form of cost of goods sold. And $2, this were not sold. They will be at the ending inventory, right? So in this case, your revenue is $20 minus your cost of goods sold is $8. So your operating income is $12. So you can see under absorption costing, the income is $12, but under variable costing is $10. So there's a difference, right? So we have a formula to reconcile the difference. The formula goes like this. Operating income under absorption costing minus operating income under variable costing equals the fixed manufacturing costs in the ending inventory minus fixed manufacturing cost in the beginning inventory. So let's test this formula using this example. So I know that my absorption income is $12. My variable is 10. So 12 minus 10. Okay, 12 minus 10 equals my ending inventory, the fixed manufacturing cost left here is $2. And the beginning, this is the first year for operation, right? The beginning inventory is 0. So 2 minus 0. So you can see that 12 minus 10, the difference in the income equals the difference in the inventory, 2 minus 0. So that works, right? That works. This is the first year. Suppose now we are in the second year. Suppose in the second year now, the fixed manufacturing cost for the year is $8, okay? And the revenue is still $20. So under variable costing, my income is revenue $20 minus my fixed cost $8. So that will be the $12. So under absorption costing, suppose that you sold all the productions from the first year, and you sold 7 over 8, okay, 7 out of 8 of your second year production, okay. So in our assumption, we sold the remaining production carried from the first year. In addition, we sold 7 out of 8 of second year's production. So what happened is the $2 at the last year's ending inventory, which is also this year's beginning inventory. So that is sold. So that will be part of the cost of goods sold, $2. So 7 out of 8 production is sold in the second year. So 7 out of 8, that means I have $7 in the cost of goods sold. So only $1 left in the ending inventory. Okay. So now I have the same revenue, $20 minus, now my cost of goods sold is $9. Okay. So what is this $9? $2 are from the first year's production of goods, and the $7 is from current year's production, second year's production. So together, that's the $9. Then my operating income is $11. Okay, for the second year. So now let's try using the second year's figures to test this formula to see if it's correct. Absorption income, that's 11. Variable costing income, that's 12. So 11 minus 12. Okay, that's the difference in the income. finished manufacturing cost in ending inventory, you can see here, that's the $1 left, right, at the end of second year. Minus fixed manufacturing cost in the beginning inventory. So second year's beginning inventory is the first year's ending inventory. So that is the $2. Okay. So you can see 11 minus 12 equals 1 minus 2. So that's good, right? So this equation works. It's balanced. So I hope using this example, it helps you to see that how this fixed manufacturing cost flow and why that operating income will be different and how to reconcile them. So now let's think about how does changes in inventory affecting the operating income. So the first scenario is in a year, the volume of production equals sales volume, right? So in that case, your inventory level will not change, right? So basically, your fixed manufacturing cost in the ending inventory would be the same as the fixed manufacturing cost in the beginning inventory, right? So in that case, you can see these two are equal, and then these two incomes must be equal. So in that case, if production equals sales, your operating income numbers should be the same and both costing. Now, what about production is greater than sales? So if production is greater than sales, right? So that means you didn't sell everything you produced. So whatever unsold, that's building up the ending inventory. So your ending inventory would be higher than the beginning inventory. So the first number is greater than the second number. So my first income should be greater than the second income. So in that case, my absorption costing income should be higher than the variable costing income. Okay, so absorption costing income is higher than the variable costing income. So what about production less than sales? So if production less than sales, so then it's going to be the opposite. Your ending inventory is lower than the beginning, and the variable cost income will be higher than the absorption cost income. And here, there is performance evaluation issues, right? So suppose like many of the corporations, they probably try to motivate their managers to do a good job, right? So let's say once you reach certain operating income threshold, you will get a bonus, right? So in that way that managers will work very hard to try to achieve the goal, right? So in that case, managers have opportunity to manipulate the income if it's under absorption costing, right? So take a look at this column, absorption costing, right? So in order to achieve a higher operating income, you can see for under absorption costing, this is how the income statement is prepared for the external users. You can see that this income is higher when production is greater than sales. So then what is going to happen is the manager can just overproduce their items, right? So that the amount of the fixed manufacturing overhead cost allocated to the cost of goods sold, that proportion of allocation is lower. So therefore, the cost of goods sold would be lower and the income will be higher. Okay, so and then the manager will have a better chance to achieve the bonus, right? So that's the story that if manager know that, oh, I'm almost reaching my operating income, so in order to secure my bonus for the year, I better try to produce more things, more products, right? So that I can absorb that production, fixed manufacturing overhead cost production in the ending inventory, not on the income statement. Okay, so then maybe the for performance evaluation purpose, the company wants to avoid the managers misalign the interest in overproduction. So then the company will say, well, guess what? We're going to calculate the operating income under variable costing instead of under absorption costing. So that will eliminate the opportunity for the managers to increase their income by overproduction. So you can see that, you may wonder, okay, so we have learned about absorption costing, right? Why we would even need variable costing, right? So you can see this will be one example that variable costing can help the organization, right, to avoid some managerial misalignment of their interest. And of course, it's going to add a little bit more work to the company, right? So it's already a lot of work to prepare absorption costing financial statement, but now you have also prepare the income statement and the variable costing. Other ways to manipulate income, they could produce product that help them to absorb the cost on the balance sheet. Okay, so they would pick products that will absorb the highest amount of fixed cost, right? The cherry picking. And they could also defer maintenance, right? So in order to have a higher income, they want to lower the cost. Maybe they should maintain their machines this year, but they don't want to spend that money, because if you spend money, that's your cost, your expenses. That's going to reduce your income. So instead, guess what? Although I need to prepare some machines according to the schedule, but I would rather delay that to January 1st so that it will be counted as the next year, right? So that is also one way. If they try to cut off the expenses, that would also help them to increase the net income. Okay, so let's review. Well, which of the following would not be considered a period cost on a absorption costing income statement? So which of the following would not be considered as a period cost? So the answer is variable fixed manufacturing overhead cost. So under absorption costing income statement, both variable and the fixed manufacturing overhead cost are considered as product cost. Okay, and for fixed marketing sales cost, so this is a period cost under absorption costing. So the fixed cost, okay, fixed cost, fixed marketing, fixed period cost. The mean cost, this is a period cost. Variable marketing and sales cost, this is a period cost under absorption costing. For this question, you have provided with the following information. The company has no beginning inventory, produced 1,000 units and sold 950 during the current period. What is the inventory cost per unit and the variable costing, absorption costing? Okay, so first, under variable costing, what is the cost per unit? So variable cost per unit, so I will see variable costing. What's the inventory cost, right? So that means these ones are the inventory cost, okay? So that would be this one, and this one, right? So together, that would be the $26, right? $26. So you may wonder why selling and the min $3 is excluded, right? That is excluded because that is not inventoriable cost. It's not a product cost, right? So this are the variable product cost. This is a variable period cost. So they all variable cost, but this 3 is variable product cost. This is a variable period cost. So only the variable product cost, they are the inventoriable cost, goes into the inventory, right? So therefore, we know that that's the 26. So A is eliminated. So what's the cost under absorption costing? So under absorption costing, you have to include fixed manufacturing overhead as your product cost. How many units of production? So there's 1,000 units production. So my fixed overhead cost is 20,000. I need to allocate this among 1,000 production. So for each unit produced, the fixed manufacturing cost is fixed manufacturing overhead cost is $20 per unit. So that's why I have 26 plus 20, which is 46. So the answer is the second. Answer is the second. Okay, so now let's switch the gear. We're going to talk about a variation from absorption costing. It's called normal absorption costing. Okay, normal absorption costing. So what's the difference between normal absorption costing versus absorption costing, right? So normal absorption costing, they use estimated rather than actual denominator level for the overhead cost allocation base, okay? So when you think about, we calculate overhead rate, right? We calculate overhead rate. So that would be equal to your overhead cost, right? Overhead cost divided by a base, right? Divided by a base. So this base is the denominator, and often this is the production, right? Often this is production, units of production. So for normal absorption costing, they use a estimated, budgeted base. Well, under absorption costing system, they use the actual production. Okay. And the question is why they don't use the actual denominator, actual production? Because you won't know that information until the end of the year. So that information is not timely. If you want to, do this earlier, right, you have to estimate that number, right, in your calculation. Okay. So this one is the you think about materials, okay? Think about the direct materials, direct labor. We have learned this before, I think. These are the direct cost. So you use the actual cost, actual quantity times actual cost. For the manufacturing overhead, okay, you use the actual quantity times the predetermined overhead rate. So how do you know the predetermined overhead rate? So that is the budgeted overhead cost divided by the budgeted cost driver units. Okay, so that predetermined overhead rate is based on the budget cost divided by budget level of the cost driver. So we're going to use one question to show that income statement calculations under normal absorption costing. So suppose the fix it that selling price is $20 per unit. The beginning inventory, this is the first month of production and the sales. So the beginning inventory is 0. And for the months they produced 30,000 and they sold 20,000. We have some information about the unit variable cost. So variable manufacturing is 9. That including direct materials 5, direct labor 3, variable overhead 1. So 3, 5, 3, 1 together, that is the $9. Selling and the main expense, that's also variable, is $2 per unit. And we have the fixed cost. So the manufacturing overhead 120,000. So that's based on a budget volume of 40,000. Okay. The selling and the main expenses, fixed selling and the main expenses is 15,000. So that's the fixed cost information. Fixed manufacturing overhead cost 120,000. It's based on our budgeted volume of production. That's the 40,000 units. The selling and the mean fixed selling and the mean expenses is 15,000. So the company will expense the production volume variance. So this is a new concept, right? Production volume variance to cost of goods sold in the accounting period in which it occurs. A production volume variance occurs whenever actual production deviates from the budget production. So at the beginning of the year, you would have a budget. You think this is how the level of the production. That's your budgeted production. At the end of the year, you would have the actual number. So that will be your actual production level. When these two numbers are different, which is most likely, then you have this production volume variance. Okay. And we're gonna show you how to do the calculation. Okay, so production volume variance. So that occurs when actual production deviates from budget production level. Okay, and this is only the case under absorption costing, not under variable costing. Normally, you would want write off that volume variance to the cost of goods sold. Okay. So when actual production is more than budgeted production, so you think you are able to produce 100 units, but actually is 150, right? So you work with a fixed cost, fixed manufacturing overhead cost. You think that's going to be 100 units, but in the end, you produced 150. So that's the good news. Right? That good news. So now the actual is different from budgeted. There is this variance, production volume variance. It's favorable, it's good news, right? If it's good news, that means your cost on the income statement, right? Your income will be higher and your cost good sold will be lower. So the variance will reduce the cost of goods sold, right? So reduce the cost. That's why that's making it good news, right? When the actual production is less than the budgeted production, okay? So you think you can budget 100 units. In the end, they only produced actually 80 units, right? So you are four short of 20 units. So that's bad news. That's unfavorable, okay? So unfavorable, right? So that will increase your cost of goods sold, right? Because your cost is higher. That's unfavorable, right? If your cost is lower, that's favorable. So you see the logic behind this. So when actual production is more than budget production, that's the good news. Your cost will be lower. So therefore, the cost of goods sold will be reduced by the volume variance. if the actual production is less than budgeted production, it's unfavorable. Okay, so that means your cost will be higher. So your cost of goods sold will be increased. Okay. So let's take a look at this example. So we are saying under variable costing, I have materials 5, labor 3, variable manufacturing overhead 1. So together that's 9. So this is my variable production cost and the variable costing. And the normal absorption costing, I have to also include that fixed manufacturing overhead. So I know the cost is 120,000 based on a budget production level of 40,000. So therefore, right, my per unit, I have a $3 fixed manufacturing overhead per unit. Okay, so this is normal absorption costing. Why is normal? Because this number 40,000 is estimated. Okay, so that 40,000 production level, if that's estimated, a budgeted number, then and then you calculate the $3. So that makes this to be a normal absorption costing. So this $3 more. So under normal absorption costing, that will be $12 per unit. Okay. So the manufacturing cost per unit is $3 higher under normal absorption costing because, okay, because the fixed manufacturing costs are based on a predetermined overhead rate under absorption costing. Okay, under normal absorption costing. And the variable costing, the fixed manufacturing cost are period cost. They are expensed right away. Okay. Okay, so if we prepare this income statement, this will be a good format for you to learn to follow. This has gross profit, gross margin. So this is prepared under absorption costing. So the sales is 20,000 units for the month. Each one is $20, so we get $400,000. And cost of goods sold. So inventory January 1st. This is the first month of production. So the beginning inventory is 0. Cost of goods manufactured. We know they produced 30,000 units, and we know that each unit is $12, right? The 9 plus 3. So that is my cost of goods manufactured, 360,000. And that's also because beginning is inventory is 0. That's also my cost of goods available for sale, 360,000. What is left in the ending inventory? So during the year, the production is 330,000 units. They only sold 20,000 units. So the difference is 10,000 units at the ending inventory. So each one is $12 times 10,000 units. So I have the inventory cost worth of 120,000 at the ending inventory. And that difference is your cost of goods sold, 240,000, right? So you sold 20,000 units. Each one is $12. That's the cost. So 20,000 times 12, that will be your 24, 240,000, right? So either way you calculate it, you know your cost of goods sold is 240,000. And now the actual production is 30,000 unit, actual production. So the budget production is 40,000. This is the budget production. So your actual production is less than budget production. That's bad news. That's unfavorable. So your cost will increase. So your cost of goods sold will be increased. So increase by how much, right? So basically, on your budget, okay, on your budget, your fixed cost is 120,000, but you have only applied 90,000, right? 90,000, because the 90,000 is coming from your production is 30,000 unit, and the predetermined overhead rate is $3 per unit. So 30,000 production times the rate, the budget rate, right, is $3. So that's your 90,000 fixed manufacturing overhead cost applied. But the budget fixed cost is 120,000. So the difference has to be added to the cost of goods sold, right? Because you are going to increase your cost of goods sold. Your production is lower than your actual production is lower than budget production. That's a bad news. That's unfavorable. Your cost will be higher. So that difference is the variance, 30,000, will increase the cost of goods sold from 240,000 to 270,000. So this gives me a profit margin of 130,000. And then I have the operating expenses, variable 40, fixed 15. Together, that's the 55,000. 130,000 minus 55,000. I have net income of 75,000. Okay, 75,000. So this is the income statement prepared under normal absorption costing. Okay. Appendix 8B talk about another variation of costing. So this is the variation for the variable costing. It's called super variable costing. Another word is throughput costing. So for this material topic, for the purpose of this course, you only need to know that under super variable costing or throughput costing, the only product cost is direct materials. So even direct labor, overhead, manufacturing overhead, they are not considered as product cost under throughput costing. Okay. So using the same example, in this case, if you think about the product cost under throughput costing, that's going to be only $5 direct materials per unit. Okay, so that's all I want to talk from chapter 8.